exciting time of the quarter, earnings season, and specifically big tech earnings season. We have had 6 of the 7 so-called Magnificent 7 companies report earnings in the last couple of weeks as I record this on Friday morning, February 2nd, 2024. We've had a mixed bag, I would say, with a bias towards the positive. Microsoft's report was strong but received somewhat mixed, while Tesla's was received negatively, Apple's was received negatively, and on the flip side, Meta's and Amazon's were met quite positively. Google's was also on the negative side of the ledger. Still, a mixed bag, but markets are still close to all-time highs. My name's Daniel, and this is the long and the short of the markets, where what we're going to do is take these sorts of short-term events and put them in a long-term context. This is a weekly video series. You can subscribe right here on YouTube. You can also check out middlecoastinvesting.com, where I post text versions of these videos. While I mentioned the Magnificent 7, I actually want to go back to a prior popular term to capture the hottest tech companies in the market, FAANG. And I want to talk about the one company that was in FAANG and is not in the Magnificent 7. That would be Netflix. Netflix is an interesting company within this cohort because I would argue that they and Tesla don't really fit the way the other companies do. The other 5 companies I mentioned, along with NVIDIA, which I didn't, are all arguably building the digital infrastructure on which our modern lives on the internet lives. Whether it's how we message one another, how we email, how we search, or the cloud service data providers that help modern businesses run, or even the chips on which the next generation of computing, artificial intelligence and machine learning, is trained and run, all of those belong to those other 6 companies, much more. Whereas, despite their protests, Tesla is basically just a car company, and Netflix is basically just an entertainment company. It's where we go to watch something. It's important. Both of those businesses are big, super successful businesses, but it's not quite the same category. But that's actually not what I want to focus on. Instead, I want to take Netflix's recent report and then look at how the last 10 years have gone for the company and see what lessons we can learn from that. I'm no expert in Netflix, nor in media, nor tech in general, but it's a stock that I've talked about a lot on my podcast, The Razor's Edge, and I've followed as an interested observer, even though, as I'll come to at the end, never a shareholder. Let's go into the last 10 years of Netflix, and then let's talk about 4 lessons that I took from those 10 years. 10 years is an arguably arbitrary period to look at Netflix, but I think it's a useful one. Not just because we think of time in decades as humans, but because I think it defines a pretty good period in Netflix life. It comes after Quickster, after DVDs as a main business, after it dethroned Blockbuster for video rentals, and it comes after it was clearly on the path that has led it to today. After House of Cards and Netflix clearly going into original content. After Netflix had started its international expansion. Netflix was clearly an internet video business, as it called itself then, and that put it on the path to today. What's that path? Where do we close the parenthesis? As of its Q4 2023 report that it released a couple weeks ago, Netflix is forecasting to be positive free cash flow over a 10-year period, meaning once you add in the free cash flow it expects to make in 2024, the trailing 10 years will be positive free cash flow, a period of heavy investment. It's a period where Netflix will expect to make quite a bit of money in 2024, both from an EPS and free cash flow basis, $6 billion in free cash flow, which is a little bit less than 2023, but still a strong number in the company's history. And it's a period where Netflix is growing subscribers, accelerating subscriber growth for the first time in a couple years. It has achieved a couple of key strategic shifts, and within all of this, its peers are all in some form or another in shambles. Netflix, I think it's relatively safe to say, at least from today's vantage point, has won the streaming wars. And while there's no promise for the future and things can change quickly in this industry, Netflix is now clearly dealing from a position of power after what was a retrenchment in 2022, a rougher year where they had to recover. What are 4 lessons we can take away from this, which will get us into some business analysis and some stock analysis? Let's start with one key important one to disclaim everything else that'll come after it. It's easy to declare Netflix as a winner now, but let's be careful of assuming that it was easy to do so 10 years ago. I'm going to zero in on 2 key periods of doubt that the Netflix shareholder might have had. One is 2018-2019, which is a period when, on the one hand, competition is finally there. For a long time, Netflix was playing its own game, but all of a sudden you have Disney Plus, HBO Max, Amazon Prime Video really expanding, Apple Plus, Discovery Plus, lots of pluses, but pretty much every business in the media industry was getting into the streaming game one way or the other. There were very few who decided that they could just provide licensing video to other platforms. Everybody thought they needed to own their own audience, which made Netflix's life much more questionable, it would seem. They were no longer playing on their own. And at the same time, Netflix was burning a lot of money and investing a lot of money and borrowing a lot of money. At the end of 2019, the company had burned $10.7 billion in free cash flow over the prior 6 years. Its net debt was at a peak of $9.7 billion. That's a lot of money, not so much in comparison to the company's market cap, which Reed Hastings liked to do at the time, but in terms of if you're losing that much money over that period and then you're borrowing money, are investors ever going to get it back? It seemed to be a fair question. And at this time, just to be clear, Netflix was trading at 83 times trailing earnings, and it wasn't much better on a go-forward basis, something like 56 if I'm not mistaken. This wasn't an easy time to hold or buy into shares if you look at it from that perspective. We, of course, didn't know that there was a pandemic that was going to come, which was going to, A, goose Netflix subscriber growth for another year, pulling forward some subscriber growth, which we'll come back to in a second, but also slow down Netflix's spending so that it turned a corner on free cash flow. Positive in 2020, almost positive in 2021, and then increasingly positive in the last couple of years. We didn't know that was coming. But then there was another turning point, which was 2022, in Q1 specifically. Netflix shares plummeted down to the 160s level, a 75% plus drop from its all-time highs in late 2021. A turnaround of only 5 or 6 months. Really narrow window for such a heavy sell-off. What was happening? Netflix made it clear that it wasn't going to grow the way it used to. It said the days of expansive subscriber growth were over. It started making excuses. It pointed the finger at password sharing. It said, actually, maybe we need to finally start thinking about having an ad-supported tier. These were fundamental cultural shifts in Netflix's philosophy. It used to be in favor of password sharing. Now it said it was going to start cracking down on this. The future seemed a lot less exciting. There was a lot less growth left to Netflix, it seemed. It was an easy time to give up and sell shares. Many did it. One was a major new investor at the time, Bill Ackman, the head of Pershing Square, a major hedge fund. Bill has been in the news for much stupider reasons recently, but his investment in Netflix came right before this sell-off, and he sold, saying that the future was unpredictable. And it was a fair argument. It was reasonable to think that. Pershing Square has made a number of amazing calls over the year, but they didn't see the case for Netflix at that point. In hindsight, that proves to be roughly a bottom, and Netflix has basically tripled since that period. But it wasn't as easy as it seemed. It's important when we get into all of this to remember the concept of survivor bias. Looking in hindsight, Netflix has won, and so it's easy to see that this is the story that will play out, but it's never that easy in real time. That's an important lesson that we should always remember. Even given that hindsight or survivor bias, which we'll come to some counterexamples of in a second, there's one business aspect of Netflix that I think you could argue you would have seen all along and would make you bullish even throughout this 10-year period. And that's this. Netflix was a big player. It had the muscle it needed, but it was also the only player that was living and dying by the business model that it was going after. In other words, Netflix sold subscriptions to watch videos online, to watch television online, however you want to call it. That's what Netflix did. It didn't have to worry about burning its legacy business. Already 10 years ago, the DVD business was clearly a side thing. It was clear that at some point it was going to get to the last DVD that Netflix sent out, which happened in the last 12 months. That writing was on the wall, and Netflix was ready to focus on just one thing. Whereas other businesses had the classic innovator's dilemma. Can I shift to what I need to do in the future at the risk of my existing businesses? In Disney's case, the movie industry and ESPN and ABC and all its other cable businesses. NBC Universal also has a major cable business. Could it focus on online video? Wasn't as easy. All of these businesses, HBO is another example, and HBO was also a part of other huge businesses at different times. Time Warner, then AT&T, and now Discovery. It's all these challenges that Netflix just didn't have. Meanwhile, Amazon, Apple both entered the streaming business, but they didn't live or die by it the same way that Netflix did. They could have success, but there wasn't the same sort of discipline and focus in their business, and they weren't going to go as big as Netflix had to survive. Netflix got lucky in all of this, to be clear, in one major way, which is that it was able to build a financial muscle through debt, which was cheap throughout this period. Interest rates, even at its peak in 2018, were nothing like what they are now. So Netflix was able to borrow money at a lower rate that they could then spend on growing their business without having to worry about it in quite the same way that a business would now. Netflix was also lucky that investors would lend it money at a relatively low rate to its financial profile. So we have to acknowledge the part of risk. But Netflix focus is something that you could have noticed at the time and believed in. I'll give one example of a business that I've invested in for similar reasons, though I should say that I'm not so bullish on it at the current price and have been selling. And also, it's a common comparison to Netflix, and I think it's dangerous to make that comparison. Spotify. It lives and dies by selling subscriptions to stream music in a degree that Amazon and Apple, its major competitors, don't. It's just a part of their broader portfolio. Counterexamples to this, to go back to the Magnificent Seven, are businesses like Slack and Zoom, which competed with Microsoft Teams, a inferior product. And I just was on a Teams call. It's deeply inferior. But Microsoft, even though that's not their main business, was able to build up Teams usage way above Slack and potentially Zoom in a way that is, in Zoom's case, it's less obvious with Slack, severely crimped its growth. And so there is this sort of focus may not on its own be enough, or the point of muscle is important to not overlook. Nevertheless, I do like the idea of investing in competitors that are focused on a specific area in a way that their larger competitors are not. And I think that's something you can take away from the Netflix story, and something that you could argue would have kept you bullish throughout the last 10 years. There's a great saying that I saw on Twitter at some point in the recent months, though not so recently. And I don't remember if it was a famous hedge fund manager or if it was somebody anonymous that the tweeter was quoting, but said something like this: I don't need my analysts to tell me when a cheap stock is cheap. I need them to tell me when an expensive stock is cheap. That's when it's interesting. Netflix has always been an expensive stock, and yet it was a cheap stock if you look at it, again with the benefit of hindsight, 10 years ago. 10 years ago, when it filed its 2013 10K in early 2014, its shares traded at 219 times trailing earnings. If you went forward, it was 93 times, still expensive. If you went forward 3 years to 2017, it was 46 times. If you went forward 6 years to 2019, it was 14 times. Finally, a reasonable number. I'm giving you the actual earnings number though. So we're talking about 6 years ahead, actual earnings that you couldn't have precisely known that far behind. That's the first time that you get a cheap earnings multiple. And yet, if you own Netflix through until when it filed its 10K just a week or two ago, you would have made 25.7% a year. An amazing return, more than double the market, I believe. At the same time, move forward 5 years, and all of a sudden your return is not terrible, but it's 11.6% from filing of the 2018 10K to filing of the 2023 10K. This actually does lag the market. Netflix even reports this in their shareholder letter, though their endpoints are a little different than mine, so it's not going to add up to quite the same. And if you go 3 years, all of a sudden Netflix is either negative, again, depending on your endpoint, or at the very least, not a very attractive return. Which isn't to say that Netflix was necessarily a bad investment for those latter 2 periods, because you would have had opportunities to buy on dips and to knowingly do so. Again, I go back to that 2022 example. A true bull would have had reason to know that the story was going to turn. But I do want to make clear that this is what makes an investment like Netflix, in my view, such a tricky one. It was never a cheap one, and the valuation does bear out. You could have nailed the thesis in 2018 and still not done all that much better than the market. You could have nailed it in 2013 and you would have done amazing. That's what attracts people to these sorts of stocks, but it is also what increases the degree of difficulty, at least how I view it. Which brings me to my last point. You have to know what sort of investment you're making, what sort of bet you're making, what question you're trying to answer or predict the answer for when you put your money in a business. Professor Aswath Damodaran of NYU is if not the expert on valuing companies, and he has the following graphic that I'll flash on the screen. It basically talks about the life cycle of a company, from its fast upstart days to its more mature cash cow finish. It's not a one-way street. He actually posted this in an article about Microsoft in 2015 under Satya Nadella, when it actually reinvigorated its growth cycle and has become the, again, dominant player in its field like it was back in the 90s. But in general, companies tend to have one of these cycles, maybe 2. When you invested in Netflix 10 years ago, you would have done so not to expect cash back anytime soon. In fact, the company would have burned $10.7 billion, as I mentioned, over the next 6 years. You were doing it because you knew that it was expanding into a new market, because you thought it could hold its own, beat competitors, and grow its business into what would eventually become an attractive business. At least theoretically, that's what you were doing. And you would have pointed to subscriber growth, as so many people did. Subscriber growth was never less than 18.4% in a given year for the next 7 years, and the compound growth was nearly 25%. It was 24% is the number I have. That's impressive subscriber growth, and that was what drove the story for Netflix. And again, going back to 2022, what was profound about that moment was that the story shifted. Subscriber growth could no longer be in and of itself a driver, partly for pandemic reasons, because the pandemic pulled forward the numbers and it threw off things, and we'll see what the normal is for Netflix in the next couple years. But also, it was just not, there weren't so many people left in the world. Sure, there's the password sharing and whatever else, but at some point, Netflix was going to reach saturation. At that point, it needed to start making real money. And the story is now shifted to one that's more cash flow, EBITDA, dollar driven rather than subscriber driven. And Netflix, to some degree, is delivering on that. Like I said, they're going to get to a positive free cash flow point for a 10-year trailing period for the first time in, I don't know exactly, but in several years. They expect to make $6 billion in free cash flow in 2024 after making almost $7 billion last year, with some dynamics around the writer's strike throwing things off. In any case, that's an impressive number, And they're now a cash flowing business. It's now a different sort of investment. And that was the investment that you could have seen in 2022. And people did. My co-host on my podcast, he made the case for how Netflix was going to start making cash. He was aggressive with his number for 2023, but still undershot what Netflix would eventually make. So you could have seen that, but you had to shift from, am I looking for subscriber growth and growth, or am I looking for cash flow? When you make an investment, you need to know what is it that's going to drive the successful investment. The investor who was able to hold for 10 years and see both successful investments, that is an impressive, flexible investor, or a lucky head in the sand investor. Either way, in this case, has worked out well. I'd like to wrap up with what I'd say is a fun paradox about investing. On the one hand, I'm a big believer in the concept that there's nothing new under the sun. Whatever happens now has probably happened in one form or another before, and you can find echoes and learn from history all the time. I don't know what the precise parallels to Netflix might be, but chances are there are stories like this that you can find if you dig through time. The comparison of Amazon to Sears may be an easier one to make, and it's one that people have made as an example. At the same time, as investors, as humans who don't have millennia of history to live, we are always learning new things, and the market will always teach us new things that we can take and apply to the next story, to the next pattern, to the next situation. I've used 10 years of Netflix's lifetime, but really you could expand through the company's entire 25-year plus span to find several business case studies that will last over the years. Whether it's beating out Blockbuster and being the hot upstart, whether it's how to respond to short sellers, as in Reed Hastings' famous response to Whitney Tilson back in 2010 or thereabouts, whether it's handling a debacle like the Quickster rollout and that whole story. And now, whether it's shifting your business, focusing on a new vertical, disrupting legacy players, and carving out not only a niche, but a lead that has become a truly profitable business that has put Netflix at a place above its peers. These are all stories that will be valuable to people in business and valuable to us as investors. Which is not to say that we always learn our lessons. I've mentioned, I have never owned Netflix shares. It's always seemed expensive to me. And the one period where I probably could have figured it out and should have was that 2022 period. And I still just said, nah, too much noise about it, too much in the news, still too expensive, not for me. I missed out on a triple in a story that I probably should have understood. Which is to say, we're always learning. And with a stock like Netflix, it'll be entertaining one way or the other, whether it's just as a subscriber to Netflix as a product or following the stock in the market. I hope this video was both educational and entertaining for you. My name's Daniel. This was the long and the short of the markets. Again, a weekly video that I try to put out about short-term events and how they matter for the long term. Subscribe to get more of this. Thank you so much for watching if you got in this far. And check out middlecoastinvesting.com if you want to see a written version. And I'll see you next time.